One of the primary applications of Python is, let's say, in trading, and how it is applied in trading is beautifully summarized from this workflow. So, this is very beneficial in the sense, just imagine a trader who is doing everything on its own, and compared to that, let's say he gets his task done in an automated fashion by typing some lines of code in Python. So obviously the second one is much more efficient and less stressful compared to doing every task on your own. So that is one of the key benefits of Python. Now the next question would be how exactly to achieve that. So I've broken down a trading strategy into four different steps. So the first step in creating any trading strategy in Python is to get the required data. So data you can think about is the information on which the your Python code will decide what action needs to be taken. For example, the looking at the data, the rules can be defined, and based on the rules, the buy and sell decision on a particular stock can be taken. So data becomes an important source for your Python language. Second is once you have a data, it's very huge data. From that, you should screen the data. For example, you can screen the data. You can find the stocks which are trending currently using Python. Let's say you can apply a filter where you can calculate the returns for last 3 months and identify the stocks which are trending, and so on and so forth. You can apply a lot of screeners which you are using currently. Let's say once you have the screener ready, and then you will be deciding, okay, these are the 10 stocks which are trending in last 3 months. What do I do with that, right? So that's where the alpha comes into the picture. Is basically the brain of your strategy, which decides what exactly needs to be done. So you can have more indicators, you can have more analysis. For example, you can use some statistical tools, let's say like a Hurst exponent, or maybe even another technical indicator, let's say like RSI, and further decide exactly is this the right time to buy into this particular stock. So for example, let's say for Tesla, all the conditions are good, all the logic which you have defined are good. Then you basically place a order, buy, and finally there are these exit conditions after a couple of days, and you exit from the stock. And let's say you make $10 out of it. So basically, this is $10 which you made from a single trade. Similarly, you can take multiple trades throughout, let's say, for last 2 years, and finally you analyze of how the strategy actually worked. Like, was it profitable overall? So you check the total PNL, and it comes out to be, let's say, $200. So it seems like the strategy was profitable throughout. Then you have different lenses. You analyze the strategy from different angles, like what was the maximum loss which the strategy made, what is the win ratio, how much is the profit factor, what is the Sharpe ratio, so on and so forth. So all this can be easily done in Python with few lines of code. So just to reiterate, Python is very much beneficial for research purpose. Let's say if you have read the newspaper, currently it says that inflation globally is very high. So currently the UK inflation came out to be 9%, and even for US and everywhere around the world, the inflation is very high. So natural tendency after reading such news is, if inflation is very high, the stock market is not going to work, and the natural reaction to this kind of news is you simply go and sell your equity holdings. But wait, this is now how you should be doing it. Ideally, you should be analyzing the data for last, let's say 20 years. You should identify, or maybe even for last 100 years, and you should identify the years where the inflation was, let's say, above 8% or above 7%. And then you try to see that on those years where the inflation was above 7%, what happened to the stock market. So if you see during I think 1970s, the inflation was very high in US and the stock market returns were almost close to zero. But if you see for Japan, the same conditions were true, but the equity markets were very good. So this gives you some better analysis, better judgment of what exactly you should be doing with your equity holdings and not sell in rush. So this is one of the key advantage of Python. Like if you have the right kind of data, you can perform your research and come to a better conclusion. And this also helps with the second point is validate your hypothesis. So your hypothesis was selling when the inflation is high. Is the hypothesis right? So if you go back to US and see the decade where the inflation was high, it seems like it's a good idea to not have equity holdings because on that particular decade, the returns from US stock market was almost close to zero. So you validate it and then it makes sense to take those decisions. And third is analyzing the performance. So you basically check the returns. You would have looked at various parameters of what happened during those decade, what was happening with crude oil, what was happening with GDP growth, how does it correlate, and you do all those kind of a detailed analysis. And finally, let's say you have a strategy in place. You write down some few lines of code in Python and this will automate the stuff for you. So whenever those conditions occur in future, you straight away the code will straight away take the decisions and place the orders. So your emotions won't be captured. Your brain will not stop you or give you some fears or give you some greed to manipulate your decisions. The decisions are already there.